thank you for joining our webinar today. This is the second of a three-part webinar series where we're looking at the 2013 outlook on what's going to happen in this upcoming year. Today we're going to be focused on corporate governance in 2013. I'm proud to have both Lydia Beebe, the Corporate Secretary and Chief Governance Officer at Chevron, and Friedman, the Managing Partner at CamberView Partners, with me today, and they'll be providing their expert insights and experience on the matter of corporate governance. So we look forward to their input and their insights as we get into the subject matters. As a reminder, you can see on the slide in front of you that we will be having one more webinar in 2 weeks looking at the evolving board pay and structure. And that should be a good one as well, as we have Ted Dysert from Heidrick & Struggles and Lynn Joy, a senior advisor from Equilar, who will be presenting with me again on Wednesday, February 27th. So again, thank you everybody for joining us, and if you haven't signed up or if you haven't planned to listen to the one next week, please do so. If you'd like to listen to the recording of the one we did 2 weeks ago looking at executive pay, please let us know and we'll make that available to you as well. Looking at the agenda for today, and obviously if you're talking about corporate governance, there are a whole laundry list of topics that we could get into. Unfortunately, we only have an hour, so we're not going to be able to cover everything, but we thought we'd look at three key topics that relate to Equilar clients and that we deal with on a regular basis. The first is shareholder engagement, something that certainly has been a big topic of discussion over the last several years, especially because of say on pay and the relationship between investors and companies and the amount of conversations and, again, the level of engagements that are going on there. Then we'll talk about the communication through proxies and how that has evolved over the last several years and what's going into that and what we're seeing and again, what we expect to see in 2013. And then we'll finish up with a discussion on shareholder proposals. We'll talk about all the proposals that are coming, not from the company, but from shareholders, and we'll be discussing those at the end. And so let's get started with our first topic, which is shareholder engagement. Again, this is a very popular topic, something that we've seen become very important over the last several years. It's always been important, but I think has received more notoriety, more scrutiny, and I think companies are looking at their practices and what they need to do surrounding engaging the shareholders over the last several years, specifically in relation to say on pay. If we look at some examples of what companies are doing, more than just engaging through the proxy, you can see that a company like ExxonMobil is providing a webcast to fully explain its compensation decisions to investors. Again, providing another avenue for their investors to get more context, to get more information around the decision, specifically around compensation, than just the annual proxy that has been traditionally sent out and has typically been about the only place where the discussion of compensation has been out there in the public. Also for Allstate Corporation, they met with a lot of their large shareholders, which has been something that we've seen a lot of, and Abe and certainly Lydia will be able to discuss that. But they passed their say on pay vote, but Allstate, through the discussions, made several changes after communicating with their shareholders, specifically around the target level of their compensation and looking at things like the equity of performance, the equity awards and the performance shares that are being granted. Again, we're seeing a lot of companies, after discussions, having very fruitful conversations with their investors, and then coming out of that, being able to make comments and adjustments and build a better pay package, one that is that investors are happy with and one that shareholders are happy with. Of course, the big driver for a lot of this engagement, at least as far as Equilar is concerned, is say on pay, and how that has put a lot of companies in a position where they want to make sure that they are able to explain the decisions around compensation and to put their compensation decisions and policies and practices in its proper context, especially with the presence of things like negative recommendations from proxy advisory firms, where a company like ISS or Glass Lewis goes out and makes a negative recommendation to shareholders about the vote for say on pay. And if we look at some numbers here among the S&P 500, a number of companies over the last couple of years have filed amended proxies, specifically discussing the negative recommendations from proxy advisors. This is something that you didn't see much of several years ago, but with say on pay becoming a mandatory vote for companies, and in 2013 we're going to see a lot of the smaller companies that were able to avoid having to have a say on pay vote will be forced to have one this year. We saw a number of companies come out and make specific points about what the recommendations consisted of from either ISS or Glass Lewis, and tried to counter those. So again, trying to engage their shareholders and explain their side of the story so that it was understood, so that as the say on pay vote approached, that the vote would reflect a strong understanding of the policies and the decisions behind that, and would again result in a favorable vote. Typically what we saw as far as say on pay votes was concerned was about 2 to 3% of companies failed. So not very many, but a lot of companies certainly were concerned when a negative recommendation would come out, and I wanted to make sure that they were able to pass and that investors had all the information necessary to be able to make an informed decision and again, hopefully pass their vote. If we look at an example of a company that responded to criticism, H.J. Heinz does a great job in their amended proxy of defending their pay practices and basically laying out the differences between their pay and the way ISS was looking at their information through the use of their peer group, essentially pointing out where the discrepancies are, where ISS's analysis and evaluation of their pay practices differed from the way Heinz felt that they should be looked at, and differed from the way that Heinz was looking at pay relative to their own constructed peer group. And so that's something, again, we're seeing a lot of, and we've seen a lot of over the last couple of years, as companies are looking to explain those differences and address those directly, as opposed to letting those go and hoping that investors would be able to do that, would be able to notice those discrepancies or be able to check those differences on their own. One more point, and then I'll bring in our experts here, is if you look at the people who failed their say on pay in 2011 and what their responses to that was, you could see that about 56% of companies the shareholder had shareholder outreach after they failed their vote. So again, a lot, in most cases, majority of cases, companies looked at their failed vote as in part because of a lack of communication between the company and their shareholders. And when they failed, they reached out to the shareholders, solicited their opinions, their thoughts on it, and in a lot of cases, they went out and made those changes because in some of those situations, they were fixable problems or situations where either a company needed to give more disclosure or be more specific about their goals or metrics. And so the companies were able to go about and do that. And again, only 5 companies failed in both 2011 and 2012. So failing your say on pay vote was certainly something that was fixable for the majority of companies that did fail in 2011. And I would assume that that's the case in 2012, but we'll see. With that said, I'd like to bring in our experts, Abe and Lydia. And Abe, why don't I start with you? Looking at sort of what we've seen from corporate governance and specifically having to do with shareholder outreach, are we seeing any different, what differences are you seeing as far as companies' approaches to engaging with shareholders?
Well, first, Aaron, thanks for having me on. I appreciate being invited to participate today. I think that if you take a step back, there's actually a really meaningful shift that's happening right now in the market around the way in which companies are engaging with their shareholders and the expectations of shareholders with respect to engaging with companies. it's only been really in the last few years, I think, that the companies have found themselves in a position where institutional investors are more and more willing to vote against companies when they think that something is amiss, or vocally, stand up and push on companies to make change. And part of that is a reflection of what's happening in the investor community and the pressures that large asset management firms who may have been quieter on these issues historically are feeling from their own clients to be seen to be behaving as owners of these companies and not just holding these stocks on behalf of their clients, but because their interests often are so substantial across a broad set of clients that they should be behaving in a way that an owner of a company would might be expected to behave in a private context or other context. And as a result, you have these corporate governance teams within large asset management firms that are increasingly becoming more influential. They're receiving more support economically within their firms. So they're hiring more people. The quality and the talent of the people in those organizations is upgrading as they get more experience and as there are more resources to hire people with varied backgrounds. And so the upshot is that companies are really facing sort of a new infrastructure within their investors, and having then, as a result, to figure out how to engage in a way that's going to help them be successful. And while companies may historically have invested, even millions of dollars in having the best IR folks and developing their relationships with their fundamental portfolio managers, engaging with these governance teams is a different thing than traditional engagements that companies do with portfolio managers. And I think one of the things that we've seen, certainly with our clients and with other companies that we've witnessed and talked with, is that trying to understand how to approach the folks in the governance community and position what companies are doing in a way that resonates with those folks is becoming increasingly more important.
And you bring up that certainly the way to engage investors and the different types of investors is important. Do you have any suggestions about how to deal with the largest, the biggest ones, the Fidelities, the BlackRocks, the large institutional shareholders that do have holdings across thousands of companies and certainly don't have all the time in the world to sit down and chat with every single company?
Yeah, I think most companies are lucky to get one meeting, maybe two a year with those folks because, again, unlike traditional portfolio managers, those folks are voting thousands of meetings a year, and so their ability to sit down and talk to everybody is limited, or at least to talk to them on a regular basis is limited. So, I think, planning ahead and understanding and learning who the folks are who run these functions and thinking about how they make their decisions, how each of the unique large institutions, they all operate a little bit differently from each other, but how do they go about their process of figuring out how to vote on an issue is very important. And then, as much as you can do to engage with companies, with institutional investors in the off season is really helpful, because when you're going to an institutional investor in the middle of proxy season, it's a really big ask to get them to give you their time and spend what limited time they have with you while they're voting thousands of meetings in a very compressed time period. It's harder to get their attention and to really dive in. But if you have invested in some engagement in the off season and got to know the folks at those organizations and built some relationships, the conversations when proxy season rolls around and you do have an issue that pops up become a lot easier, I think, generally.
So you're not suggesting that you wait until a week before your annual meeting and call up all your investors and try and plead your case?
Well, I do think that once you're in season, most of the big institutions won't talk to you until it's very close into your meeting. But no, I'm not suggesting that. I think that the best approach is one that's sort of carefully planned and thought out early and leads to sort of some understanding of your investors and what they think and where they are and issues that might be coming up for you in season, and then following up in season as necessary, and that sort of that last week or two before your meeting.
When you say early, how early are we talking about? 6 months, a year, or 3 months? What do you think is the right time frame?
We are working with our clients to help them conduct their engagements and really get to understand kind of what's on the minds of their institutional investors in the fall. So in the September, October, November timeframe, certainly. And then there's still some time right now before proxy season heats up. I mean, most corporate governance teams are really gearing up for the season, and they've got a lot of prep work that they're doing. But there's still a little bit of downtime through the end of February, really. Once you get into March, or certainly anywhere past the first week or two in March, then you're really in season, and those folks are really not going to engage until very close to your meeting date, typically, if they have time to engage at all.
That's great. Lydia, let me bring you in here. Speaking from obviously the experience of the corporate side of things, what have you found that works well when you were trying to engage with shareholders?
Well, I think knowing them in advance is the thing that helps you the most. I do think we've gone through an evolution of this in our company. We started out, of course, it was just here in the governance group, myself and one or two other people that called people every proxy season. And then we got to the point of trying to see the governance people and talk to them outside of the proxy season, but again, only us, and some of it was planned and a call or when you happen to be in town. Other of it was, having a more active role in the CII, the Council of Institutional Investors, and some of these other, the Stanford Institutional Investors Forum, where you can actually see these people during the off season and get to know them a little bit more on a personal basis. And now that has evolved to a broader effort this year within our company to have more organized meetings. Most of them are by telephone with our larger stockholders to just talk about some of the issues from the prior proxy season, any that we anticipated for the next proxy season, and to involve a larger group in the company. So to have some of our environmental experts and some of our HR folks, different people that don't ordinarily deal with that group involved. And so I think if you get to know people outside the proxy season, it's very helpful in getting them to return a call or answer an email in the proxy season. The most important thing for you to do is really have a good sense of whether you're going to have any issues that are of concern to them. All of the large ones that you were asking Abe about, they all have, virtually all of them, not all, but most of them they'll talk to you anyway, have their own proxy voting policies available publicly, and they also generally have a little bit of an explanation on their website about how they make their decisions, whether it's a proxy committee or the portfolio manager or that sort of thing. So you can get a fair amount of the information online, and then when you have a conversation with these people, you can be a little bit more informed about their process. But I agree with Abe about planning ahead. I think you have a better uptake from people if you send them an email first and tell them you'd like to set up a meeting or a conference call, give them a little time, and then work with their schedule to do that. In the proxy season, I have found, of course, all my experiences with a very large cap company, and so people tend to give us a little bit more time and attention. But I certainly have found any time in the proxy season that we have a controversial issue or an issue that I really want to spend a few minutes talking to people and our big stockholders, people in their governance groups about, that I have been able to get that time. So I really encourage people to try. But, it's always much harder to try if you don't have any relationship at all or haven't had any contact with people.
Sure, that's a great point, and that you said specifically around larger bigger companies, especially one of Chevron size, that would, more likely get the return call. Is it for smaller companies? Is it a much more difficult thing to get people to pick up the phone, or is it pretty consistent across the board? If you call and you plan, you're probably in good shape.
Yeah, I might have a better feel for that. I mean, I do have a belief that most of these people are very busy, but they're also very courteous and thoughtful. And if you reach out and give them some advance notice, particularly outside the proxy season, certainly my feeling that most of them would respond. Again, during the proxy season, you're going to have an issue that's important to them as well as to you to get their attention, I think.
Sure. And when I ran the corporate governance function at BlackRock and before that at Barclays Global Investors, we always had an approach that we didn't base our decision to engage on the size of the company or any other attribute of the company other than what the issue was. So we were very issue-driven. So if a company was raising an issue with us that we thought was important and where engagement would add some value and help us really understand what it was that the company was doing, then we engaged on it regardless of the size, and even frankly regardless of the size of our own holdings, because our view was we had a fiduciary obligation to get it right, no matter whether it was a small investment or a large investment. The fiduciary obligation was the same. So I think a lot of institutional investors, the large institutional investors who are really focused on this, and as Lydia characterized it, who will engage, take a similar view that they're willing to engage if they think that there's an important issue being raised, and it's one that engagement would be useful on.
Sure. Thank you. That's a good point. Let me ask you this then. We're talking a lot about picking up the phone, calling, or meeting these people in person, or having webcasts or anything like that. That's obviously a little bit more work intensive, and having to reach out a little more personal. How important then is the proxy in the whole process of engaging shareholders and specifically telling your story regarding the different topics?
I think the proxy is the number one, because that is really where people look first for the information. And most people, certainly the proxy advisory firms who make their recommendations want to see something in public before they rely on it, but most stockholders also would like to see something publicly disclosed as an indication, that it's really the policy or what the results are, rather than just having a conversation and being assured that you're making your best efforts on something. So I think the proxy is very important. Of course, that's what ISS and Glass Lewis, that's one of their main source documents. So if you don't get your arguments out in your proxy, if you don't get that right, you have much less of a chance of getting a recommendation that's consistent with what the board is recommending to stockholders. So I think that's pretty critical. I do think it's important for people to anticipate what what the recommendations are going to be from those proxy advisory firms. I mean, you talked about some examples of people having webcasts and going, making a big effort to reach out to stockholders. But in many cases, anyway, those are reactions to an adverse recommendation, and particularly on the compensation side, where people really have a lot of emotion. And so you really ought to, kind of have a clear view ahead of time of where you're going to be on that, so you can plan those things out in advance. Because if you're in a situation where you're likely to get an adverse vote, that would be, or an adverse recommendation, that would be the number one case of where you better start reaching out to your stockholders early and often.
Yeah, I completely agree with Lydia and everything she just said. I think that the proxy statement is really critical for all the reasons that Lydia mentioned. I will say that for companies who have a real issue, a real problem that they're expecting they need to address in their annual meeting, I look at the proxy statement in that case as really your opening argument. I mean, I think there are other things that you'll want to do to follow up on that, but making a really good opening statement is really critical in presenting what it is that you are trying to do and your arguments and reasons why shareholders ought to support you. And so getting all
proxy as an opening argument, I think that we'd well into the next section where we're talking about the communication through proxies. And if we look at some of the numbers, count of the average word found in the CDNA for the S&P 1500 is actually has been increasing over the last 3, 4, 5 years for a number of factors. If we look at the breakdown between the different amounts, you can see the majority of companies typically have between 5,000 and 7,500 words. So pretty long statements, but we've been seeing them, like I mentioned, we're seeing those proxies, those CDNAs, get longer and longer, and that can be due in part to increased regulation where companies are having to disclose more and more information, whether it has to do with stuff around the peer groups or performance metrics. Obviously, Dodd-Frank has some issues in there where potentially it could get even longer if companies have to talk about a CEO pay ratio rule and provide, again, more context around the decisions that are being made. But that's something that I think we're continuing to see the opening argument, as he put it, get longer and longer as companies try and put more information in there and have greater dialogue. One of the things we're seeing as companies are putting more importance in the CDNA and trying to make sure that their conversation around compensation specifically is the use of more graphs and charts, which seems pretty basic, but in a lot of ways that I think we've seen companies view that as a very helpful guide to be able to tell the story. As they say, a picture is worth 1,000 words, and we already see that the proxies and the CDNAs are quite long, and so being able to abbreviate that, I'm sure the investors appreciate that, as well as the team here at Equilar, as we're going through and trying to decipher all the information. But you see a company like Archer Daniels Midland, which breaks out their pay and uses things like pie charts and showing the breakdown of pay and uses the use of different components. Another thing that we're seeing, again, as companies are looking to better tell their story, is they are spending more time in the CDNA instead of just hitting the check marks and saying, well, here's what we use for metrics, and here's the base salary, and here's all the equity components, is making sure that they're promoting their own view of pay for performance. Again, as the proxy advisor's recommendation on Senate pay has received a lot of notoriety and is certainly a concern for many companies. Companies are going out and making sure that the way they look at pay, instead of relying on the SEC mandated tables, the summary compensation table, they're going out and they're talking about pay the way they view it, whether it's the use of realizable pay, which is a certain calculation which factors in how much the equity awards that have been granted over the last several years are worth, and showing that relative to their peers, and then comparing that to how they're doing versus the total shareholder return. Companies are doing that, and then you also see the use of things like realized pay, which oftentimes can be called take-home pay, which looks at how much executives are investing in stock and how much they're exercising in options. So again, we're seeing more and more companies go about their disclosure and trying to make sure that their story is told in the way they want it told, and to be able to make it clear to investors, because they view the proxy and the CDNA is so important, that they're making sure that their story is well told and clear and concise and understanding for the investors to be able to make good decisions. So with that said, let me bring Abe and Lydia back. And Abe, let me ask you, do you think that with the CDNAs getting longer, do you think that this is a trend we're going to see, or do you think it'll eventually level out and companies will will reach somewhat of an equilibrium?
Well, I'm sure it'll level out, but I think that right now, we have several clients who either failed their sound pay vote last year, or where it came far too close for comfort, that we're helping navigate these issues and get to a better place with their investors this year. And one of the key things that we're advising them is to do a better job of articulating right up front in their CDNA, so their own story and their own message so that shareholders understand what it is that the company was thinking. What was the compensation committee thinking when they made the decision that they made? What are their best arguments for why they have chosen to go down the path that they have, really in an effort to give shareholders the opportunity to understand from their perspective what's really happening around compensation. And included in that, we're encouraging people to do exactly what you said you're seeing more of, which is to put more charts and graphs and use other tools that are available to really illustrate clearly for investors kind of what metrics and what data there is that the company is relying on to make those judgments. And we think that, that's a really important tool and important thing for companies to do, because the CD&A can be treated, and it has been treated, I think, by many companies as just a compliance exercise, and there's certain prescribed elements that you have to have in there from the SEC and otherwise. And, that might be fine for a company that really doesn't have any issue around comp, or people there are no red flags being raised. But for companies that are doing things that are a little bit unique, or that are raising eyebrows because maybe they don't fit into a standard kind of approach that investors might use or that proxy advisors might use for evaluating these things, it just becomes really important if you want the support of your investors to really take the time to explain to them specifically what are you doing and why should shareholders feel comfortable that that's really what the decisions that the comp committee has made are actually really in the best interest of the stockholders.
Now, Lydia, let me bring you in here and ask you, from Chevron's perspective, how has the process of putting the proxy together changed over the last 5 to 10 years?
Well, I think the process has changed in large part because the disclosure regulations have changed, and then you talk about it getting longer and longer or leveling out. I mean, I do think most of the increase in the length of the proxy is driven by the regulations, and I think if we don't get any new regulations, that we'll have to level out at some point in time, but the regulations are very seldom stay the same for too many years in a row. I kind of think about the evolution of the more charts and graphs. The proxy is primarily a legal disclosure document, so it penned mainly by lawyers who are more word people than they are picture people, and so I do think the development of charts and graphs in the proxy has been slow in developing, in part because the people who write it, that's not their forte and not how they think. The charts and graphs really kind of came in a little bit in a bigger way as part of executive summaries that people started doing to try to make it easier to communicate your main points. And I think that the reception they got, which was very positive, I think, across the board, has encouraged people to do more and more of that. But our process is really to get the information, as best we can from the human resources people on the CD&A. I mean, the proxy, you get the information from whatever source across your company. That's the best source of the information, but we certainly have always had lawyers involved in the drafting of it and putting it together and then vetting it, with all the, internal people involved, and then, of course, the board and the CD&A particularly is vetted, a number of times with the compensation committee to make sure it captures what they are trying to communicate. But there has been some increase in the length of the proxies and some kind of the art of the preparation of the proxies internally is to try to draw out what the compensation committee contemplated or it was thinking or how it weighted different factors in these different decisions that the committee made. And, all that is again, encouraged by the stockholder engagement that you may have had up to that point, because you do get some stockholder questions on, we'd like to understand a little bit better how you consider these various factors when you come up with this, or why this looked that way. And so then that tends to add to the narrative. And one of the best things I think people can do is really try ahead of the compensation committee meetings to decide, these big compensation aspects, to really see, have the disclosure written up or going to be in the proxy if they approve a particular action, so that the comp committee can see what it's going to look like in the proxy ahead of time. That sometimes is helpful in crystallizing, kind of what the committee emphasizes or what they think is important to them, and they will then communicate a little bit more to the drafters what they want to see emphasized in the narrative. And so all those things are helpful.
And when you bring up the sort of ever ongoing battle between the company lawyers and the SEC and the investors, want more information and they want more clarity and things simpler and everything written out. And from the company standpoint, a lot of times, although many are obviously willing to give as much information as possible, there is the fact that it is a legal document, and so making sure that you don't expose too much information to give away a competitive advantage or write something down that could put you in a legally precarious situation is certainly a struggle. From an investor standpoint, are CNAs, obviously they're getting longer, but with more pictures, which is always nice. Is it getting easier to read?
I've been looking at this from an investor lens for the last year or two. I've been helping companies in this regard, but certainly I think that when I look at these things with my investor hat on, they're definitely getting easier to read, and they're getting much more user friendly in the sense that companies are not just treating them as a strictly, let's just put the information in there and move on, like from a legal and compliance perspective, but let's actually take the opportunity to talk with our shareholders or message to our shareholders around what it is that we're doing. So I do think we're moving into a better iteration of this, but I think it will continue to evolve, and I think some companies have still not gotten there. And I think that the one risk for companies that choose not to message in the CDNA is when they wind up with a problem, they're sort of on the back foot if they haven't already either done the things we've been talking about in terms of developing relationships with their investors and really understanding how they think and how they make decisions, and if they haven't really been using their proxy as an opportunity to tell their story. That's sort of a double whammy and really puts companies behind the eight ball.
Sure, that's a great point. Thanks. I'd love to keep talking about this, but why don't we move on to our last section? Since we're about out of time, we'll talk about shareholder proposals. And if we look at some of the numbers that Equilar has been tracking in terms of looking at proposals introduced by shareholders over the last 2 years, and these are proposals that have made it to the proxy, so these are not ones that have been issued and withdrawn. But you can see that the number has gone up from 2011 to 2012, but the passage rate has gone down a little bit. Now, there's been some research out there, obviously depending on the types of votes that have showing some support greater support for some people or for some types of shareholder proposals versus others. If we look at the different categories, and if you log into Equilar's product, this is how we have the proposals classified. But you can see that social and environmental policies, shareholder proposals, typically are your most popular ones. And that's what you'll get the most of. Last year, board management actually was the most popular. You can see it went from 31 to 38% of all proposals were in the board management, which, to give a little bit of clarity about what we classify as a board management proposal, is things like the declassification of boards, term limits, the separation of the CEO and chair, and other things like proxy access. And so that saw a bit of a spike last year. Social and environmental stuff typically is the most popular. If you look at a breakdown of the different types of proposals and what was popular last year. In 2011, you can see that political contributions, which, again, these are all categories that fall under the social and environmental category, is about 43% or 44% of the proposals were discussing something about asking for disclosure around either political contributions by company or lobbying efforts and things like that. Of course, last year was the presidential election, so it was clearly top of mind for a lot of companies, but I think we've continued to see that into 2013 as investors are concerned about where company dollars are going in terms of either lobbying or political donations. You see environmental is the second most popular, and those political contributions and environmental were the most popular by far. And then, of course, there's some other ones having to do with human rights, animal welfare, board diversity, all obviously topics of importance, but not nearly as much as the first two. If we look at some of the political contribution proposals that were out there, for Bank of America, and of course for the Wall Street firms, that is a very hot topic. A lot of people were concerned about that. For Bank of America, they had their shareholder proposal asking for full disclosure of their policies governing their lobbying efforts, including where their payments went and to whom. And then Walmart had their one asking for the company to produce a semi-annual report updating the shareholders on the amounts that they paid for lobbying for any political party or organization or a candidate. And, Lydia, obviously this is something that you have to deal with that's specific to Chevron and in your industry. What are for your investors, and obviously it's distinct than maybe what you'd see out there across all companies, but what are the type of shareholder proposals that you typically see and have to deal with?
Well, we probably get as many shareholder proposals in our industry as any industry across the board. I mean, the natural resources, we probably get the most. I think ours have historically been about half environmental, social, and most of those environmental, and I would say a half governance, and then in some rare cases where in the past we've had some on compensation. We did get the political contribution disclosure proposal last year. We actually got two proposals for this coming proxy season on the political contributions, one on a disclosure and one to cease, activities in the political space. It's interesting to look at and see who generates these stockholder proposals. We tend to get, all of our proxy, all of our political contribution proposals have come either directly as a filer or co-filers from some of the union pension funds, which of course are very active in this space. And I think we've seen this big uptick in the political contribution proposals because of the Citizens United decision, which happened, of course, right before the presidential election. And so there was a lot of money that went into some of these political organizations that are not included in normal lobbying reports. And I think that has driven a lot of this. There's been a lot of attention paid to indirect lobbying, and a lot of the conversations around some of those shareholder proposals have been all about the trade associations you give to and how much of that money goes for lobbying. And so in some ways, it is a space that people are very interested in, and to the extent that some of the proponents have different political interests and some of the companies do sometimes, it's, everybody's interested in knowing more about that space and looking for more disclosure and in some ways more public scrutiny to it. In the environmental social area, we get a lot of proposals from religious investors as well as from some of the social and environmental pension funds. And so we tend not to get any proposals or almost none from our largest stockholders. But not to say some of the larger stockholders don't support some of these. It is just the stockholder proposal process has generally been used by stockholders who present as much of a position in the company, and they use this as more of a public arena to give attention to it. We do spend a lot of time on this proposal process. I have often said that it's, it is a way for even the smaller stockholders to have their issues considered at the highest level. And but we get so many that it is a significant use of company resources to develop responses and to consider the proposals, and I think that's something stockholders should be aware of.
Is there, in your experience, is there an effective way to deal with shareholder proposals so that they don't end up on the ballot? Like you said, you get so many, and obviously you don't want to have all of them on there. Is there sort of a best practice or a way that you guys typically are able to address it?
Well, it's long been our policy to engage with every proponent of every proposal and to have conversations with them to see if there's any meaningful room to have discussions and negotiate a withdrawal by addressing or being responsive in some way. It's a difficult process, frankly, because many stockholders want everything. You know, they don't want to compromise, and we in some cases don't want to compromise. And so while everybody engages and we talk to each other, you know, many of these conversations are both giving our side and thinking we're going to persuade the other side. And so, you know, that doesn't lead to so many withdrawals. I do think, to the extent that groups are really interested in learning about you and impacting your activities, the company's activities over time, you know, we have had certain groups that we've engaged with over year in and year out that have had a significant impact on our policies that the company might adopt and how we implemented them. But those are not necessarily the majority. And I have to say, we, other than repeats from the prior year, we seldom, if ever, know we're going to get a shareholder proposal until it comes in by email. You know, there's this idea that people are going to talk about this ahead of time, and a shareholder proposal is the last resort. But everybody has a full plate, and often, you know, proponents and people who tend to bring these things up, they get busy and they do other things, and they do have a real interest in putting these proposals in, and so they're driven by the company's deadlines more than anything. So, you know, I think the calendar forces you to make early decisions on whether you're going to seek an SEC letter that allows you not to print something and to write a response, and you know, a response to the proposal generally in opposition. Sometimes you find one that you want to support in principle. But, you know, because of the calendar and the printing of the proxy and the SEC deadlines, you're kind of driven to get all that started probably before or at the same time you're engaging with the proponents. And so you just march down the calendar and see if you could find any grounds for meaningful engagement. But in our cases, you know, I would say that's a minority of the shareholder proposals. I think we print a majority of the ones we receive. There's always a few that fall out, but some are for technical reasons or because we got a duplication, that sort of thing.
Okay, and Abe, let me ask you, what advice do you have in terms of dealing with shareholder proposals?
Well, you know, in my experience, really there are a small handful of shareholder proposals that tend to get over majority support ever. Typically, almost anything that comes up in the environmental or social category does not get over a majority vote, and that's because most large institutional investors think that those issues belong to the board and management team, and they don't choose to use the proposal process to tell the board or management team what they think that they should do. They would sooner get a different board if they think the board's not getting it done right than to tell the board how to do its job. But there are some proposals around governance issues where companies do wind up having, you know, some meaningful risk of having their shareholders vote against the board's recommendation. And in those situations, you know, I think, again, getting to know your investors, being able to have conversations with them and understanding where they're coming from. You know, obviously a firm like ours sort of exists to be able to help companies understand the institutional investor community in a way that maybe a few years ago wasn't all that important, but has become very important. And so, you know, getting good advice and really understanding who the folks are who are making these voting decisions and what's going to resonate with them and how they're going to think about these issues. So when you have one of those sorts of governance proposals that can get shareholders, you know, in large March numbers really riled up, it becomes really important to engage and understand where they're coming from. And certainly, there's also on the internal side, the folks who are responsible for these issues, making sure that the board and the management team are fully aware that, what issues are coming and how investors are likely to respond to them, so that there are no surprises when the votes come in.
Yeah, thanks. That's great to consider. Lydia, I love the point you made that, as Abe referenced, most of these shareholder proposals typically don't pass, but just because they don't pass doesn't mean that they don't have an impact, and certainly it can shape company policy if they're sort of in there. And so that's always good to keep in mind, because as we're looking at the success or failure of a particular proposal, the ultimate approval percentage doesn't necessarily mean that it did or did not have an impact. So I think that's something obviously to keep in mind. I'm looking forward to seeing what sort of shareholder proposals we'll see in 2013 and which ones pop up and which ones are unexpected.
Well, if our results or the proposals we received are any indication, most of them will not be new. Most of the ones we received were ones we've had before.
Okay, yeah, that's good to know. And, we don't have an election this year, so people probably won't be as politically charged as they were the year before, although I'm sure when it comes to politics, people are always charged up about it, so I'm sure we'll see a fair share of that.
Well, that's why I mentioned Citizens United. I don't think it was just the election that drove that huge number of political contribution proposals, and I think in the aftermath of the Citizens United and the amount of money that's still being spent, even after the election on some of these various cause issues, I think that'll still be an issue this year. Yeah,
it's a great point. I think you're very right in terms of it wasn't just the election. It was in large part due to Citizens United. I think until there's somewhat of a resolution as far as companies are concerned and investors are concerned about what's an appropriate level of disclosure, and everybody sort of comes to an equilibrium, I think it's going to continue to be a topic that will be discussed and thrown onto proxies. Well, that is it for today's webinar. I appreciate the great insights that both Lydia and Abe were able to provide. For all the attendees, please fill out the survey on your screen here, rating the content of today's webinar. That would be very helpful. We appreciate you all doing that. Again, I'd like to thank everybody for attending, and I'd like to especially thank Lydia and Abe for their time and wonderful insights and being able to talk about corporate governance issues and what we've seen and what we expect to see in 2013. If we didn't get to your question, I apologize, but we will hopefully be able to respond to that afterwards. Again, any information, the recording of the webinar and the slides will be made available in the resources section to this webinar. So again, thank you everybody for joining, and have a great day.
Thanks, Aaron, for having me.